One of the main reasons why China's bonds are not attractive for FX reserves is that foreign investors have been selling them since Russia invaded Ukraine in 2022, due to fears of sanctions and geopolitical risks. According to Exante data, foreigners have sold $115 billion of Chinese bonds from February 2022 to March 2023, reversing a decade-long trend of net buying. This shows a lack of confidence in China's financial stability and its political relations with the West. The sell-off was triggered by the Russia-Ukraine war, which raised the possibility that Beijing's ties to Moscow could expose overseas holders of Chinese assets to international sanctions. China is one of Russia's major allies and trading partners, and has supported its military intervention in Ukraine. Some countries, such as South Africa, have already faced sanctions for providing arms to Russia. Investors are worried that China could also face similar measures, or that it could retaliate by imposing capital controls or restricting access to its markets. Another factor that has deterred foreign investors from buying Chinese bonds is the narrowing yield gap between China and other major economies. China's 10-year government bond yield has fallen from around 3.2% in January 2022 to around 2.8% in May 2023, while the U.S. 10-year Treasury yield has risen from around 1.5% to around 2.5% over the same period. This means that the return on Chinese bonds is less attractive compared to other safe haven assets, especially when taking into account the currency risk and the transaction costs. Therefore, foreign investors have been reducing their exposure to China's bond market, which has implications for the yuan's role as a global reserve currency.